back to the Patrick Lane Show, where we talk about personal finance, investing, and real estate. And today we're going to touch on something that's kind of been in the news, but could be worrisome, or maybe it's just make-believe. Who knows? Before we do that, do me a favor, smash the like button, hit the subscribe button, ring the notification bell. We really appreciate your help in growing the channel. And, smashing that like button really doesn't cost you anything, just a tiny second to tap it. And it really helps us a lot to get YouTube to push the videos out to other people who may be interested in seeing it as well. On Friday, the PPI number came out, which if you don't know what the PPI number is, that's the Producer's Price Index. So most of us, when we think about inflation, that's what we're going to talk about. Think of the Consumer Price Index, which is Consumer Price Index is what the goods that consumers typically purchase will go for. So the government, the BLS, looks at a basket of consumer goods and then adds that price up and then determines that, looking backwards, what the price is compared to what the older price was. And the increase over that is the Consumer Price Index inflation rate. And so one of the things that people are worried about right now in the economy is inflation, obviously. And, some of the things that will drive inflation are the easy money, easy access to money from fiscal policy or monetary policy, a unemployment rate that's higher than it should be, and a sort of a general economic malaise. Now, all of those things happened, if you remember, back in the late 70s, early 80s, and, were eventually curtailed with tax cuts and priming the economy in the 80s, so that it led to the growth of the late 80s, mid 80s, late 80s, 90s, and really into today. That primed the pump for a lot of the growth that we've seen over the last few decades. So with the issues in the economy in the last year that we all know, right, we're all stuck at home still, that inflationary worry has started to rear its head because we've got easy monetary policy. The Fed is buying bonds like crazy. They're printing money like crazy. They're making it easy for companies to borrow money. The interest rates are at zero, essentially. Then on the other side of that, you've got Congress and the government still sending out additional funds to consumers in the form of stimulus payments and rebates and all that sort of thing. And so we've got all of this excess flood of money in the system. And, the easiest way to think about it is, if there is one pair of shoes at the store and you go to buy that pair of shoes and your neighbor goes to buy that pair of shoes at the same time, then guess what? One of you is going to offer a higher price to the merchant and they're going to sell those shoes at the higher price. Well, if that happens over and over and over and over consistently, then the price of those shoes is going to go up. And it's any product. It could be shoes, it could be food, it could be electric, it could be anything, automobiles, housing, whatever the product or service is that you're thinking about. So as those prices go up, it happens because people have more money available to them to spend. Well, with zero interest rates, with money available in the system, with the Fed printing money, with everybody getting checks, we're expecting, right? Everybody's in this mindset that there's going to be inflation. And that is one of the major components. It's almost a self-fulfilling prophecy of inflation going up because we think inflation is going to go up. We think it's going to go up, so therefore it goes up. And then we think it's going to continue to go up, so therefore it goes up more. Now, that's not a real scientific explanation or an economic, science-driven explanation of it, but that's the real world reasoning behind how that happens. So we got our first indication on Friday that there may be some inflationary forces in the economy, and that was the Producer's Price Index. So the CPI is the Consumer's Price Index. So when you and I as consumers go to the store, what do we pay for something? What do we pay for milk, bread, eggs, shoes, whatever? That's the consumer side of it. The PPI is the Producer's Price Index, and that came out on Friday. So it's the same thing except it's for producers. When a producer wants to make a car, when they want to make a camera, when they want to make a computer, when they want to make a pair of pants or a pair of shoes or produce a jug of milk, then that index takes into account all of the components of producing goods and services in the United States and creates an inflation index the same as the CPI, except it is one step removed. It is the wholesale side of it, the producers of goods and services. What does it cost them to actually produce the goods and services? So their inputs, the cost of their inputs, and what does it cost to make that? So if you think about, a prime example is lumber right now is sky high. Lumber is 4 times higher this year at this time than it was last year at this time. And so if you were building a house last year, that lumber cost would have been 1/4 of what it is this year. The lumber cost this year to build a house is 4 times what it was last year. So if you are a home builder, if you're a home developer, your cost to produce, your producer price index on lumber is a lot higher this year than it was last year at this time. And so the PPI numbers came out on Friday, and it showed that, yes, indeed, in fact, the PPI number was up historically. This is the highest, 4.2% is the growth year over year, is the largest growth increase in the last 10 years. So it's not just that we're recovering from the pandemic, which is sort of what we expected, right? We expected maybe the largest growth in the last year, maybe the last 2 years, if you go back to 2019 instead of 2020, because everything was sort of shut down in 2020. But no, this is the fastest growth price increase in the last 10 years, which is really sort of a worrisome number. Now, typically what will happen is that PPI number will then filter over to the CPI number. Now, it takes a little while. It's not a matter of days. Maybe it might happen in a few weeks, a few months. But obviously, if think about a car manufacturer, right? If you're Tesla and you're out there buying metal and you're buying batteries and you're buying tires and you're buying all those things to put your car together, you've got to purchase those things. If the price of all of those component parts go up, then that is going to narrow your margin and it's going to create a higher price to produce those cars, which those things are typically going to get passed on to the consumer, which means that the consumer price for a car that's made today, when we end up buying it in a few months, may be a higher price because the component parts of that car are higher to make. Now, the balancing flip side of that is that we've got Jerome Powell out there, the Fed chair, who says they're going to do everything they can to keep inflation low. And he thinks, frankly, that the inflation is a transitory shift, which means that he thinks it's only going to be for a short period of time. So as people get back to work, as the economy starts churning again, as more areas open up and things get back to normal, that he sees a spike maybe in inflation, but then it's going to drop back down and it's going to normal out to our historic 1% to 2% inflation. So that's kind of what we're thinking right now. It's a worrisome, inflation is a worrisome thing, because if you're around or if you know about what happened in the late 70s, early 80s, I mean, you're talking about mortgage rates that were in the 15% range. You're talking about car rates that were sky high. Nobody was really happy with where the interest rates were. And the Fed at that time had to raise interest rates so high to clamp off the growth in the economy. And then you combine that with the oil embargo and unemployment rate and all those sorts of factors that were going on back then. And it really worked to shut down the economy in the late 70s and early 80s. And it wasn't until 83, 84 that those things really fell by the wayside and took off after there's some structural changes from the government side. So do me a favor, let me know down below, comment, let me know what you think. Is inflation a real concern for us who are investing, who are buying stocks, who are buying real estate? Or do you think it's just something that Jerome Powell is committed to dealing with and pushing off to the side so we don't have to worry about it. Let me know your thoughts down below. Comment. Do me a favor and smash the like button, hit the subscribe button, and ring the little notification bell, and we'll see you in the next video.